Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be talking about this continued commodities bull market as we're seeing gold continue to push higher, over 2,400 easily now. Silver is up another dollar today, over $32. Copper up to $5.10 a pound. And even natural gas, it's closing in on $3. This commodities markets are moving and they are continuing to pull a lot of the stocks higher. So again, it's what we're going to be focusing on with Craig Hemke, founder and editor of TFMetalsReport.com. Craig, look, pricing wise, there's no denying that these markets are breaking out, and silver up another dollar today with gold up about $21. As I said, it's base metals, it's energy, it's precious metals moving higher. What has your attention, especially when it comes to the precious metals in terms of some of these new pricing levels that we're in?
Yeah, it has certainly been interesting to watch as we've been watching this pretty closely. Well, obviously for a long time, but particularly since the 1st of March. Was back on Friday, March the 1st, when Fed Governor Waller gave a speech talking about future QE, and gold shot $30 higher that morning, finished at an all-time weekly high and at a breakout of what was about a 3.5-year sideways consolidation. The price took off with COVID and then, went sideways. Well, the longer something goes sideways, the more people are apt to see it when it breaks out. And so gold broke out, made that closing high on Friday, March the 1st. And by Friday, March the 8th, it was $100 higher. It rallied 4% the next week because everybody's like, oh, look at this, it's a breakout. And new speculative cash rushes in, and now, we're another $250 higher from there. Well, silver hadn't broken out. All through March and April, it remained below 26 and then maybe got up to 28, briefly trading higher than that before getting reversed. Well, guess what? Now, back on Friday, it broke out too. So after a big rally on Friday to post that breakout, silver's up another more than almost 4% today. If it were to follow gold's course, gold rallied $100 or 4% that next week after the breakout. What you could expect from silver? 7-8%, maybe. And then we'll see where we go from there. But yes, definitely eye-opening and attention-grabbing to see it finally break out and now be trading at more than a decade highs.
Yeah, Craig, I was just going to mention we haven't seen these levels that it closed out on Friday and that where it's at today since 2013. So, it's pretty wild that silver investors have waited so long at first for the break above 26. Remember that? Then we're waiting for 28, 29. Then we're waiting for that $30 ceiling to get cleared. Not only did it get cleared, but it definitively closed on a weekly basis above 31. So it gave a lot of people an eye-popping, eyebrow-raising experience, and it really is bringing in the animal spirits to the sector. There's been a lot of excitement in not just the silver stocks, but the gold stocks. So is this the breakout that we've been waiting for to really get some momentum that's sustainable in the sector?
Probably, right? We just keep waiting for people to be as excited about the mining shares as they were 10 years ago or 30 years ago or, whatever. And there's always going to be, as we've discussed every week, there's always going to be great bargains and great companies to choose from. If you want to watch something all week long, use the GDX, the big ETF, as a proxy for the mining sector and watch its price. Because if you go back to 2011, to that all-time high in the GDX, and you start a trend line there, it connects perfectly with later highs in 2016 and again back in 2020. And that line, if you extend it down, is almost right at where the GDX is today. Well, actually, with the GDX higher here on Monday, it's briefly trading above that line. That would be, I call it on the chart, the mother of all pennants, because there's a rising floor off the lows in early 2016. But boy, this would be the mother of all breakouts. What is that, a 13-year pattern that we could finally be getting a breakout? And again, the longer a pattern persists, the more people are going to be aware of it, the more significant the breakout becomes. So let's watch that as a proxy for the mining sector. If we can get that GDX to finish the week about where it is now, even just above 37, and we'll have that breakout. That'd be something to watch.
Well, fact of the matter is there's momentum here, right? It's been 3 months, almost 3 months of upward momentum. Even GDX is up over 40% in those last 3 months. And that's even off of its lows from 2022, or even, as you said, going back to 2016. So, Craig, in this environment, right, everyone's saying, oh, well, has it gone too far? Or just how much longer could it go? This is not the time to be exiting the market, right? With all the bull markets that we have in investing world, this is another one that, in all fairness, these things usually do run longer than 3 months, don't they?
Well, and that becomes a question, right? I mean, we've all felt like we've had the rug pulled out from under us so many times that you get a little skittish. One of the old adages at my site that goes back to the beginning all those years ago is you always got to be prepared. If you're trading, you always got to be prepared to sell some when things look the rosiest and then buy some when things look the worst. And that has treated us quite well over the years. But you look at, again, is it different this time? And there's a couple of things that would suggest that maybe it is. Look at the overall stock market keeps going higher and nobody can figure out why, right? Well, geez, there's all these trillions of dollars that have been created just in the last 5 years alone. Those then can be leveraged, how many times higher to create even more dollars, to buy even more stocks. And the thing just keeps on going. You think, okay, when we talk about bull markets and commodities and things like that in the past, that was under a money supply, if you will, an investment cash supply that is a fraction of what it is today. But yet some of these share prices are the same as they were. Like we always joke about Newmont. Newmont's same price it was 20 years ago. But nonetheless, that's basically the same market cap. But yet, if you have a whole bunch, how many more trillions of possible investment dollars floating around the globe, they start focusing on this, on the mining sector, on the precious metals. Holy cow, could you get a huge move? Rick Rule likes to talk about how, back in 1980, the amount of investment assets directed toward gold and silver and the miners was like 10%. And now it's like less than 1%. Well, the thing is, for that just to go from 1 to 2% is a massive amount of dollars. I can't even project how much that could be. And then but you still have a very small potential pool of places where those dollars could go. And that's what makes you think, okay, yeah, we've come up a long ways, but man, we could still really have a long ways to go.
Well, and Craig, this isn't just happening in the precious metals to the point we've been making. It's been happening across the commodities complex. Just look at copper. Last week on Friday, that was an all-time weekly close for copper, and it beat the 2022 high that happened during the Ukraine war. So we're off to the races, and intra-week it even made a higher level. So copper is doing well. A lot of the base metals are doing well. Even some of the energy from uranium to nat gas is doing well. So it's across the board. It seems like it's more of a move into raw materials, but that copper move is also helping silver, don't you think?
Oh boy, no doubt about that. And that's something that I know we've discussed quite often in the past, and I've written about this multiple times in the last year and a half. I could take people back to my little thing I write, my little annual forecast or whatever you want to call it, that I write every January. Last January of 2023, I had a whole segment in there about copper because above ground supplies were dwindling in all the base and industrial metals, but copper in particular. And Goldman Sachs, again, this is 15, 16 months ago, Goldman Sachs was projecting that above ground copper supplies could go extinct by August, not August this year. They were talking August last year. And I was like, oh boy, if that's the case, geez, copper's going to go to whatever, $5, $6 a pound or beyond. And there's just no way that, with the pairing of, algos seem to pair copper and silver together, and they're kind of alike metals these days. There's no way silver's going to stay at, $22 or whatever it was back in January of last year. So I've been watching copper. Well, obviously, August of last year came and went. There's still some copper around. Maybe they were just early. Maybe Goldman Sachs was onto something. They're just early because you had this big rally in copper last week. And I would encourage people not to really follow the COMEX price because that's just full of shenanigans. Watch the London price. Okay, there's actual physical metal delivered there. The COMEX is just speculators and people getting screwed and, short squeezes and rug pulls and everything else. In London, it now moved today as we record this through $11,000 a ton. Okay, well, that's $5.50 a pound. What's the COMEX price? $5? So again, follow London. It's moved up through 10,000 to 11,000. Goldman Sachs thinks it's going to 12. There was an article last week on Bloomberg that was talking about, oh, this massive short squeeze in COMEX, and that could very well be the case. But the article went on to suppose that perhaps to rescue some of these copper trading giants that were caught short, that they'd have to redirect shipping traffic to New York to deliver copper. And I don't even know who writes this stuff. If the problem really is that there's a massive copper shortage, I think it can be traced to two things. You go back to April, there was the announcement from the US and the UK that the London and New York markets would no longer accept deliveries from Russia of copper, aluminum, tin, and some others. So now you got a massive supplier that's been withdrawn. And please, everybody, do not forget the largest copper mine in the world is located in Panama. It's called Cobre Panama. It's operated by, First Quantum Minerals or something like that. A lot of royalties, like 17% of Franco-Nevada's royalty payments come from that mine. And Franco-Nevada went in the tank, as did First Quantum, because Panama decided they didn't like the terms of that deal anymore. And they shut the thing down 6 months ago. Well, that mine cranks out 1.5% of global mine supply every year, 350,000 tons. That mine alone. Now, you relate this back to the COMEX. COMEX, anybody can pull this up on the CME website. COMEX has 20,000 tons vaulted for delivery in 6 places around the U.S., 20,000. And they're talking about, well, maybe we can divert some ore. Come on, man. 20,000 tons when you got offline and not producing 350,000. So anyway, that's a long answer. I apologize for getting all this off my chest. But this copper thing is a real issue. And not just today or next week, but going forward. And that will continue to impact silver prices too.
So, Craig, back to the investment potential in some of the underlying stocks and your comment on just how underinvested and other traders are in hard assets, but then also down into the underlying equities. Are you in the camp that says we need market weakness, almost a market bear market or correction or even crash to draw that money into the commodities stocks, or do simply higher commodities prices bring those investors in outside of a broad market correction?
I'm going to go with broad market correction. You mean like in equities, Corey, or
like in the S&P, the Dow, U.S. markets?
I don't think so. I would say it's maybe the former, in that I think the higher prices kind of confirm not a narrative, but some thinking that maybe commodities are coming back into focus. Maybe this is something you want to have as a small percentage of your family office portfolio. And so it becomes like a virtuous cycle. Higher prices leads to more interest, leads to higher prices. I think if you were to have a wipeout liquidity crisis, that would drive even, the futures contracts down and all these things. And then that would cause people to question that narrative. So, here we are again, maybe talking about a crack up boom type of scenario where there's so much cash printed, it just goes into everything. And we're just just looking for a little greater percentage than usual going into our sector. And that might be ultimately the key to finally seeing things really get running.
Yes, the crack up boom. Well, it is nice to see a little bit more capital coming into the resource sector, regardless of the reason. But you're pretty good at looking ahead at economic data and looking at what's going to move the needle. Anything on your radar, Craig, as far as coming down the pipeline that you think could shape the macro markets?
Oh, man, we got a quiet week ahead of us this week. I don't even know how many. There's so many Fed goons speaking each day. They're almost like, remember the old boy who cried wolf thing? Where eventually they just says it so many times that everybody just stops listening, right? Or Chicken Little or whatever, That's kind of what the goons have become. There's so many of them now. You just, headline, goon such and such says this and that. You're like, oh, yeah, whatever. I heard it all before. You know what I mean? So there is a little bit of data later this week, the flash PMIs for May, some things like that. Next week will get interesting, though. We'll get into the PCE data. Remember last week we just had all the CPI and PPI. And then, of course, the first Friday in June will bring the next jobs report. And this most recent one actually came in below expectations for the first time in about a year and a half. A lot of signals that the U.S. economy is beginning to weaken, and actually weaken quickly. And again, I'll remind everybody, because Powell has said this now on several occasions, that he will put the inflation fight on the back burner if he senses weakness in the labor market, because he does not want to over-tighten and crash the economy. So another weak jobs report in 2 weeks. And this idea that the Fed could be cutting, as soon as August or September is really going to sink in. Boy, we've had all of this rally with rate cuts being put off over the first 4 months of this year. That could be a little extra rocket fuel added to the fire if we start talking about actual rate cuts.
Yeah, we'll see when the Fed actually does start cutting rates, when other central banks start cutting rates. But right now, Craig, I think we can try to analyze these moves as much as we want. But fact of the matter is there's momentum and there is breakouts, which is the perfect environment. And that is a bull market. So let's just embrace the bull market. And quite frankly, if you are invested in this sector, well, you probably should be right now, because everything is moving higher. And maybe these stocks really get super loaded and start moving higher. And maybe they just keep following this trend. Either way, it's a good environment for resource investors, good environment for a lot of investors out there. But being so resource focused, this is much better than what we've seen really over the past couple decades outside of those true bull markets, which we seem to be in right now. Craig, thank you very much for your time. We'll hopefully chat with you next week. I hope you have a great rest of your week.
You too, guys. Have fun.